Chapter 6 discusses valuation and measurement of key balance sheet accounts. After completing Chapter 6, you should be able to define cash and cash equivalents, state how companies report short-term and long-term investments, define accounts receivable, and explain accounting for bad debts, describe accounting for inventory using the FIFO and LIFO methods, explain how to account for property, plant, and equipment, including the straight line and double declining balance methods, and summarize how companies account for and report current and non-current liabilities. We will use Research in Motion Limited consolidated balance sheet to demonstrate the concepts of this chapter. We have balances as of February 26, 2011 and February 27, 2010. The numbers are in millions. We will focus our attention on the following accounts: cash and cash equivalents, short and long-term investments, accounts receivable, inventory, property, plant, and equipment, and various current and non-current liability accounts. Cash and cash equivalent consist of balances with banks, dollar bills, coins, etc., and liquid investments with maturities of 3 months or less. It is critical to have cash to pay bills, but keeping too much cash on hand results in lost opportunities. Companies try to make investments in various vehicles such as money market, certificate of deposit, treasury bills, etc. to maximize the return of any extra cash that is not immediately needed. You can see that the cash and cash equivalents at February 26, 2011 for Research in Motion Limited are $1,791 million. The note disclosing their cash policies as follows. Cash and cash equivalents consist of balances and liquid investments with maturities of 3 months or less at the date of acquisition. An investment is an asset or item that is purchased with the hope that it will generate income or will appreciate in the future. Companies frequently purchase other companies' stock and bonds. Companies make investments to increase the rate of return or for strategic reasons, such as to be able to influence competitors, suppliers, or customers. Companies classify their investments based on their intent. If they want to hold them for a period that is shorter than 12 months, the investment will be classified as short-term and it will appear in the current asset section of the balance sheet. If the company intends to hold the investment for more than 1 year, the investment will be classified as long-term investment and it will appear in the non-current asset section of the balance sheet. Investments are recorded at fair market value. Therefore, they will be reported at the closing price on the balance sheet date. This practice results in gains and or losses, some realized and some unrealized. Realized gains and losses result when the security has been sold. Unrealized gains and losses reflect the change in market price during the period, but since the security has not been sold, they are unrealized. Some of these gains or losses are reported in the income statement as part of net income, and some of these gains or losses are reported as part of accumulated other comprehensive income. Accounting for investments will be discussed in depth in Intermediate Accounting 2 course. Research in Motion Limited's short-term investments at February 26, 2011 equaled $330 million, and their long-term investments were $577 million. Accounts receivable are amounts to be received from customers from sales on account. One of the biggest challenges in valuing accounts receivable is how much the company will actually collect, because inevitably some of the customers will not pay. The company will report the total or gross accounts receivable, and immediately following they will display an account called allowance for doubtful accounts, which will represent an estimate of any amounts that will not be collected. The difference between the total accounts receivable and the allowance account represents the net realizable value, which reflects the estimated amount of money that the company expects to collect from customers. How companies estimate the uncollectible amount is based on past history, economic conditions, and major policy changes within the company. The company makes a journal entry at the end of the period that estimates the bad debt. It increases an expense account, frequently called bad debt expense, to capture the expense in the period of the sale. or to comply with the matching principle. It will also increase an allowance account to update the net realizable value on the balance sheet. When the company identifies a customer that is not going to pay, it will write off its accounts receivable by decreasing the accounts receivable and the allowance account. This topic is studied in depth in Intermediate Accounting 1 course. You can see that the net accounts receivable at February 26, 2011 for Research in Motion Limited are $3,955 million. The note disclosing their accounts receivable policy is as follows. Accounts receivable are stated at their net realizable value. The allowance against gross accounts receivable reflects the best estimate of probable losses inherent in the receivable portfolio determined on the basis of historical experience, specific allowances for known troubled accounts, and other currently available information. The allowance for bad debts at December 31, 2011 is $2 million. Commonly used accounts receivable ratios are accounts receivable turnover, that equals sales divided by accounts receivable. The ratio measures how quickly a company collects accounts receivable or how many times a year on average. On average, the ratio ranges from 6 to 12. A ratio of 12 indicates that on average the company makes 12 collections of accounts receivable every year. Companies' credit policies will ultimately determine if the ratio is favorable. If they have credit policy payable in 30 days, ratio of 12 will indicate that the company collects right on time. Accounts receivable days equals 365 days in the year divided by the accounts receivable turnover ratio. The ratio computes the average number of days it takes for a company to collect its accounts receivable. This relationship tends to be easier to understand. Research in Motion picture accounts receivable turnover ratio for 2010 is 5, and it takes them on average of 73 days to collect their receivables. If their credit terms are near this number of days, the ratio would be favorable. However, if their credit terms are, for example, 30 days, it takes them more than twice as long to collect. Definitely unfavorable. They need to implement better practices in their accounts receivable department.